Hey everyone, today I just want to make a special video of why the market keeps on going up. Okay, today the S&P 500 E-mini futures almost touched a new high. Okay, from the bottom on the March 22nd. Take a look at this. Today the index itself went at the highest point went up about 4%. Was crazy. And this is one of the fastest rally in the recent time. I mean, we have a March 23rd, we have a crazy rally, and we had a April 3rd, we have a crazy, 2-day rally. But today is also a very vertical rally. A lot of people who sold short here are wiped out, basically. They are trapped. This was a bear trap, as I mentioned in the previous video. And I just want to talk about why the market just keeps going up despite, the current economic condition, the unemployment rate, all these bad news about the virus and the shutdown of the economy. I just want to talk about why the stock market keeps going up. The answer is very obvious, but for some reason, all the YouTubers on this YouTube just don't get it. So I'm just going to clarify this. Let me show you all these YouTubers. I actually follow a lot of channels on YouTube just to get a feel of the overall consensus of the market. So I'm actually treating the YouTubers who's making videos on YouTube as the general public. So their sentiment and their view of the world, their market view, are something I actually do look into. So I follow a lot of a YouTuber. You can see I follow all these guys here. I like this guy, Financial Education. He's actually very good. So I follow all these guys. I look at their opinions, and I want to figure out what's the consensus of the market. What's the consensus of the average market participant? What's the general sentiment in the market? And YouTube is actually a very good place to do that research. And as a rational speculator, which is who I am, I'm more leaning towards trading against the general public, because general publics are not usually wrong. I mean, they're always wrong, because the market, there's a theory about the market. It's called the maximum pain theory. The maximum pain theory of the market basically dictates the market is always going to the direction that has the maximum amount of pain to the market participant. So if everyone believes the market is going to go up, the market is actually going to go down. If everyone believes the market is going to go down, the market is actually going to go up to exert that maximum pain to the most participant. Because statistically speaking, as we all know, only 10% of the market participant in the long term can actually make money, which makes sense. So if you look at all these videos, this one video just published on May 12th. Today is May 18th. You can see this guy got 100,000 views in only a couple of days, and the title is "Upcoming Stock Market Crash of 2020." I made my comments here. I said, so many people are into this upcoming another crash or the bear trap kind of theory of 2020, that we're heading for another crash. And this is one video. You can go to all the other channels. This guy got a very fancy intro video. Let me show you. This is very cool. This is awesome. Like, this is amazing intro video. I'm gonna spend some. I think the reason my channel is not getting a lot of views because I don't have a fancy intro video as this guy. But this guy has been predicting. I've been following this guy, Game of Trades, for the last at least 6 months, and he's been predicting a bull trap since the low here, since the very low here, like since the first time we had this uptick. He's been predicting a bull trap, and the market just keep going up and up and up and up. And if you are, trading based on his advice, you would have gone bankrupt already. I mean, you have no food on the table. You're probably gonna do something like long rope. Long rope. If you guys are on the Wall Street bets section, subreddit on the Reddits. I do go there. By the way, I'm a Wall Street betters. I love Wall Street bets. You just have to do the opposite. You can't, to make a lot of money, you do the exact opposite of Wall Street bets, you can make a lot of money. Okay, so this is one guy. I can grab like 10, 20 guys like this, and all their video actually have fairly significant amount of views and a lot of subscribers. This guy is Sajad. He's been predicting a crash. Every single video of his is a crash. Okay, take a look at this. Fading, crash, tide turning, crash. We're here, crash. Next leg down, crash. Okay, crash, 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 crash. .com crash again, crash, crash. Server Buffett sales, gonna be a crash, another crash. Bears back in control, crash. That was only 2 weeks ago. 2 weeks ago we were somewhere here, you know, didn't crash obviously. And what was this guy was doing before this video, before making all these stock market video? Oh yeah, he was doing he was trying to sell on Amazon all these FBA scams. I wouldn't say the FBA is a scams, but they are. Amazon FBA is absolutely a crowded market right now. It's very difficult to make money on Amazon, unless you have been with Amazon since, you know, a couple years ago. If you enter to become Amazon FBA, it's getting, the dropshipping stuff is getting very difficult, and so obviously that kind of video, you know, didn't really get him a lot of views, and now he's just doing the doom and gloom, which is fine. I'm actually inclined, if my living is based on making money on YouTube, I would be making these kind of fear and gloom and doom, fear and videos on the YouTube, because these titles are what can attract a lot of audiences. I do have one of my video have this kind of title, and I got a lot more views than my general videos, and that's just a great way of attracting audiences. It seems that the general public, it just shows that the general public are still bearish about the market. The reason is all these fundamental data like unemployment, retail sales, everything is horrible right now. It's horrible. But people don't understand these fundamental data has nothing to do with how the stock market should behave in the short term. Okay, I'm going to explain that in a second. So here's another video. Stock market will crash again. I watched it. You can see that. I watched all these videos. Jeremy, he's a good guy actually. He didn't say that the market's going to crash. Actually, I actually like this guy. This guy's pretty objective. He's just saying the valuation in this market is quite insane. I agree. The valuation in this market does not make any sense right now. The risk-reward ratio is shit. It's absolutely horrible. But doesn't mean the market's going to crash again. We just crashed in March. We are going to stay at this level probably for a very long time, or even make it all-time high, right? The market can stay irrational longer than you can stay solvent. And the market can stay overvalued for a long time. And eventually, if the market stays overvalued for a long time, there are two results. One is that the market going to correct to the fair value in the long term, which it always does. The other one would be eventually the market can be flat, and the general economy gradually catch up to the market, which happened before as well. So there are two scenarios when the market is overvalued. So the market doesn't have to fall to become fair value, right? The economy could grow, or the economy could open back up again and to make the market more fair value. So there are two scenarios in this situation. So Jeremy does make a very good case, but he is also on the sideline. So all these YouTubers, if you watch their video, or this one guy again went to buy back in. I mean, obviously he sold all his shares. I think one of the video he said, oh yeah, right here. He said I sold all my stocks. This is one week ago. So all these guys are sold out. It just shows that in the general public, there are a lot of money on the side. There are still a lot of money on the side. This is actually a very different situation from 2008. In 2008, the average investor, we are all average investors. This guy's an average investor. I'm an average investor compared to all these Wall Street guys. These guys have billions. Okay, these guys, like the people on YouTube, they have maybe at most a couple million, which is nothing. We are average investors. If you have under $100 million, you are an average investor. Okay, and an average investor still have money on the side. Even us, a bunch of average investors have money on the side. It just shows you how much money is on the sideline. These professional investors have even more money on the sideline because, you know, the recent Fed stimulus and all that stuff. So I really recommend this video, which explains how the stock market really works. So here's the video from Institute of Trading. I think they actually do a pretty good job in terms of education and stuff. Some of the videos are very good, and they talk about what moves the stock market in the short to medium term, which is absolutely gold right here. So you have to watch this video to understand how the market works. It's the liquidities, okay? What moves the market is liquidity. The crash, if the market crashes, is usually because of a liquidity problem, not because of fundamental. If the fundamental is bad, the market can go down slowly, okay? The market crashes can only be caused by a liquidity issue. Like 2008, we had a liquidity issue. The Fed was acting too slow and the market crashed. And, you know, 1987, we had a huge liquidity issue. That's why we had a Black Monday. 1929, we had a huge liquidity issue. They all have, the market crashes because of liquidity issue. But if you go back to 2000, if you look at Dow Jones in 2000, we didn't have a liquidity issue. The 2000 market actually went down, up and down quite slowly. Over the next 2-3 years, it was able to bottom. So there are scenarios in the history where the market is overvalued and there was liquidity, so the market went down a little bit, it went up, went down, went up. Eventually, it reached a fair value a couple years later. So there wasn't a crazy crash in the magnitude of 1987 and 2008, and especially in March of this year. In March of this year, we had a liquidity issue because coronavirus hit. A lot of industries are basically shut down all of a sudden, and then everyone, all the investors are trying to raise cash. In March, the fear just completely went crazy and everyone tried to raise cash. That's why the market crashed. When everyone tried to raise cash, everyone trying to protect themselves, the market has a liquidity issue. That's why the market just went down. We had a bunch of circuit breakers. And that's what drives the market, okay? Okay, right now the market's back up because the Federal Reserve basically went in and started buying everything. Okay, take a look at this. This is something you wanted to really look at how you can analyze and assess the level of liquidities in the market. You can see that back in since 2018, the Fed balance sheet actually went down between May 14, 2018 to September 16, 2019, and it kind of went up a little bit, but it wasn't too much. Until March this year, the Fed started buying everything else. So you can see that the Fed balance sheet was pretty much flat since 2015, 2014. And now the Fed has injected about $2 trillion, $3 trillion liquidities into the economy. That's $3 trillion. Before this, the balance sheet was $4 trillion. Now it's $7 trillion. So you have all these liquidity injecting into the economy. Of course, the market's going to bounce. I'm actually more surprised the market hasn't doubled. That's just like, if you start printing money, you start injecting liquidity into a stock market, you start throwing money into the stock market, of course it's going to go up. And why is everyone trying to predict it's going to crash? How is it going to crash when there's money? There's like money around everywhere, right? Again, take a look at this. What percentage of Americans own stock? Then people talking about, this one argument, this is the stock market is really disconnected from the economy. People say, the stock market has nothing, it's disconnected to the economy. Why is that? Here's why. What percentage of Americans own stock? Here's the fact. This is from September 13, 2019, which is a year ago. The stock ownership, let me see. There are about 55% of the American actually own stocks. Only 55%. Okay? Between 2001 and 2008, there were an average of 62%. So only 55% of Americans own stock. And that is actually quite a small number, right? Think about our unemployment rate. Our unemployment rate is right now is about, I don't know, 20% in America, in the United States. 20%. That means 80% of people are still employed. However, only 55% of people actually own stocks. So out of that 80% of people, even a smaller amount of people actually own stocks. So the people who are unemployed, they're usually in the service sector, face-to-face kind of business, or airlines, all that stuff. Most of these jobs are actually not very high-paying jobs. The CEOs, the higher management level, these guys are still employed. They still have their jobs. So the people who actually own stocks are not really affected. So the average stock owner right now in this economy are still not affected by the unemployment. So unemployment doesn't really have much to do with stocks, because the people who actually own the stocks are still employed. They still have money. Let me tell you that. And what's even crazier is that, not crazy, I mean, a lot of people probably know this. Here's an article from 2018, New York Times. You can see that the 10% Americans owns about 90% of the stocks. I think it says that here somewhere. Yeah, there we go. A whopping 84% of all stock owned by Americans belong to the wealthiest 10% household. So basically, as long as these 10% of households in America are not affected by the virus, or they still have money on the side, or they still rich, you know what? These 10% of household in America, they probably don't even need to work, because 84% of all stocks owned by Americans belong to the 10%. These are the group of people in this economy. They don't need a job to survive. They don't care about unemployment. As long as they have liquidity, able to borrow from the banks, their loans, their line of credit are not being cut, they can continuously invest into this market. They still, as long as they have liquidities. These are the 10% of the Americans in this economy. They're the ones who can take advantage of the QE, the quantitative easing. They're the ones who can take advantage of the lower interest rate and benefit from that, directly from that, not from the economy where, is creating people flipping burgers and all these service level jobs, or airlines, all these, labor intensive jobs. These households, they don't care about these jobs. They don't benefit from the economy creating these type of jobs. They're benefiting an economy where the money is cheap. Okay, these guys can borrow. They're able to borrow. They have the ability to borrow from the banks. For example, myself, I have a mortgage rate right now. My mortgage rate is variable, and because I still have my job is not even affected. I'm in the technology sector, and this pandemic actually benefited me quite a bit. My mortgage is variable. My mortgage is a variable rate, and my mortgage has been brought down from 3% a year to merely 1.2% a year. And if I look at my mortgage payment, instead of paying back my mortgage for 20 years, it has gone down to 17 years, which means the pandemic actually made me a lot richer, right? I can own my property. I can own that property. Well, I don't need to. I actually don't pay for the mortgage because my renter actually pay for it. So my renters, in 17 years, I'm renting on my mortgage, and that renting my house, then that house, my rental property, will be paid off in only 17 years instead of 20 years before the pandemic, if the interest rate stays at this level. And that actually makes me richer, right? This pandemic actually made a lot of people who have a lot of debts, who have a lot of assets, financial assets, lots richer because the Federal Reserve keeps lowering interest rate. So like the top 10%, the top 50% of the economy is actually better off because of this pandemic. And here's another thing. The stimulus bill today actually just passed again. There's another stimulus bill from, this guy explains it quite a bit. Basically, there's another $3 trillion stimulus bill just passed. So $3 trillion new money going to be printed out fresh, going to be distributed everywhere in the economy. It's helicopter money. And everyone's going to be getting a paycheck soon. So all these guys are getting a paycheck. Eventually, that money, 50% of that at least, going to trickle down to the stock market. And in the short term, there's just no way. In the short term, I'm talking about not a short to medium term right now. I'm talking about within the next 6 month period or next 3 month period. We'll see how we get there. The stock market just can't possibly go down. Just can't possibly go down. So that's how this thing works. The stock market, if the takeaway here is, if you just want to take away one thing from this video, is that the stock market is not driven by fundamentals in the short term. It's driven by liquidities. It's driven by liquidity, and that's what it is. Economy weak is equal to market crash is absurd. That's absolutely absurd. You have to look at liquidity. You have to monitor liquidity. Okay, that's what it is. I highly recommend you guys watch this video. This particular video, and I'm going to post a link down to this video so you guys can go watch it. Thank you very much, and hope you guys enjoyed this video. And if you like it, subscribe and thumbs up. And I'll see you next time. Bye bye.